Welcome back. I'm joined as usual, but with Ernest Wong. How you doing today?
Doing well.
I'm doing great as well also. So I wanted to remind everyone that we're doing a webinar on October the 29th at 7 p.m. The title of the webinar is Quality Investing for the Long Run. It's a free webinar, free registration, and you can see you can join the webinar through the show notes. Ernest and I will be discussing how Baskin Wealth invests for its clients. Ernest will be talking about his research, how he does research. We'll also be presenting a couple of investment ideas and really talking about our philosophy in terms of quality investing. So I think it'll be a real good time. And at the end of the presentation, we'll be taking your questions. So once again, the webinar is on October 29th at 7 p.m. and it's free on Zoom, and we hope to see you there. So what's doing?
I was disappointed about the reaction to the last podcast.
Really? The one on Garmin?
Yeah.
Yeah.
I thought it was one of my more interesting ideas, but I guess the listeners didn't seem to agree.
Well, I think Garmin is probably a company that doesn't scream out as an exciting one, right? People say, oh yeah, I know the watches. I may have used their products years ago when I didn't have GPS in my car. But I think we did a really good job explaining all the types of the business lines that Garmin has, the smart capital allocation, the fact that it's really been a hidden compounder for many, many years. But yeah, that's fine with us.
But we did get some good client feedback who were enthusiastic Garmin users.
Yeah.
And they were pretty pleased about our thesis.
I think the people who are Garmin users who buy the watches for whatever it is, running or golf, they really like them, and they tend to be multiple repeat buyers. And I was on the water the other day kayaking and looking at all the boats, just getting some feedback, and I saw most boats have the Garmin GPS on top of them. So, you know, they're the market leader. And I saw the news today, Ernest, that Garmin has refreshed a lot of its the aerospace, the airplane business, the cockpit devices, and it looks incredible.
Yeah, a new flight deck.
Yeah, new flight deck. That's what I was trying to say. I lost the words there. So once again, we got another loaded show. We want to talk about a few of the companies that our clients own and that we own that have reported earnings, as well as a number of company news. Update you on the Couche-Tard potential acquisition of 7-Eleven. Talk a little bit about Adobe, as well as Costco, maybe Domino's Pizza. But before we get into that, Ernest, maybe some clients would be asking, guys, the market's on a tear. Market's at an all-time high. Bonds have done well this year. Gold has done well this year. Bitcoin has done well this year. Interest rates are falling. You got an election coming up. Is this the peak? Should we be worried? What do you say to clients right now, those that are looking at maybe some strong performance since pretty much October 2022? How do you calm their concerns that all will be well going forward?
Well, it sounds boring, but I think the answer is that you can't time the market.
Yeah.
If you look through the history of the stock market, it's basically gone up in a straight line, the American ones.
Yes.
And there's no shortage of things to be worried about, either at the top or at the bottom. And the best thing you can do as an investor is just to stay invested.
I tweeted over the weekend, Ernest, that the S&P 500 has doubled over the last 5 years. All right. So that means that's pretty much with dividends. That's a compound return of give or take 15% a year. So those that stuck with the stock market over the last 5 years, think about all the crazy stuff that has happened over the last 5 years. COVID, the pandemic, right? Runaway inflation, interest rates going up, straight up. Russia-Ukraine war, Middle East tensions. It's just
and
endless.
A banking crisis.
A regional banking crisis. And this is just a few of the things that pop into mind. I mean, every day there's another worry. And yet the market has climbed higher. An insurrection in the U.S.,
yes.
Right? So it goes to, what does it go to show you? That the macro stuff is important to worry about, and it may affect your personal day to day, the business that you work for day to day, your the political party that you care about, your family. I mean, these things are really important, but hard to know if they're important to your portfolio and to compounding.
No, and I think that's why we focus on individual businesses rather than what the market is going to do in any given month or year, because you don't know what, like, market could fall 10% next year.
Yeah.
But the companies that we own are going to continue to do intelligent things, and they're still building their businesses. And we think that'll work out in the end.
Let's say I called you, Ernest, in January 2020, and I said, Ernest, I know there's a global pandemic that's going to happen, and it's going to shut down the world, and get out of airlines, get out of anything travel, and never. I can't tell you if you should ever get back into them because the world's going to change. That would have been the dumbest thing in the world, right?
Well,
Airline stocks have hit all-time highs today. Hotel stocks are at multi-year high, like not multi-year, they're at all-time highs. They've done tremendous. Even if you were God and knew the future, you couldn't predict market returns.
Airlines maybe less so, but,
Yeah.
but hotels, yes.
You get my point,
exactly.
right? Yeah. It's just unknowable because, number one, humans adapt to situations, markets adapt to situations, and we never know, okay, even if the event happens, we don't know the response to the event, whether it's policy, fiscal, stimulus, God only knows. And as a result, trying to predict how the markets are going to do over those events is impossible. Best to just stick to the process that you know and understand. And I always like to think about our portfolio and the companies that we own. Are they going to be, do we at least have a glimmer of an idea that they're going to be bigger and better in the next 5 years? And what are the business models? What is the elements that these companies have that will allow them to be bigger and better in the next 5 years? Good management, great services, the ability to enter new markets. These are the things that we want to think about instead of worrying about, oh no, this politician is going to become president or prime minister and all hell's going to break loose. May or may not happen.
Exactly.
All right, so that's enough with the ranting and raving about the unknowables of the markets. Let's focus on some things that we think are knowable and controllable, and that's the companies we invest in. So Ernest, kick it off.
So Adobe, which a company we've talked about a couple times on this podcast, they just held their Max conference, which is a conference that they hold for the creative community to showcase what they're working on. And I watched the whole thing. There were some pretty impressive demos, but again, like, these are demos, so take it with a grain of salt. So there was this, like, for example, there was a demo where, like, similar to what you can do on your phones, you input an image, like a photo, and you can remove all the wires immediately. Yeah. Right. So that it's a clean picture of the person that you're taking a picture of.
You can remove all the imperfections, update it. What is it doing now that it couldn't do in the past, for example?
Well, the other one other thing that Adobe announced that was, I think, the big news of the conference was their generative text to video model, where you basically type in, like, I don't know, like the demo that they used was like a camera of an aerial flying through Mars. And it would generate a video of you flying through Mars. Okay. And, that's a pretty astonishing technological achievement to be able to do something like that.
Just type something into the text box and it will create a video for you, and it can be nuanced as well. Right. The issue, of course, Ernest, is it won't create an hour and a half video. It will create a minute or a couple minutes or less, right? Right. Give or take. So it's getting there, but still not a commercially viable option to replace commercials or TV shows or movies or videos that you really want to create for business or personal reasons.
No, and I think that was why a big theme throughout Adobe's conference is there's two things. Number one is that generating the actual picture or video through a prompt, as you can do with like a dozen tools out there. That's only the first step, right? What ultimately matters is the workflow, the ability for you to edit the work, the picture or the video that you made, and turn it into an ad or like a banner or a show or whatever, right?
So I would assume that if you're an advertiser, let's say you're Coca-Cola, and you wanted to run a campaign of Frank Sinatra drinking a Coca-Cola on Mars.
Right.
That would be hard to do right now. But if you text and prompted it into Adobe Firefly, maybe that will create a commercially viable product versus using some of the other competitors.
Right. And that was the second aspect that Adobe has placed a huge emphasis on, which is that all of the content that Adobe's models use and create, and the things that they're creating with their platforms, is commercially safe. These are so if you are, like, again, Coca-Cola, and you wanted to use AI to make an ad, you're not going to be violating some other copyright somewhere else.
Yeah.
And you're only training on things that are commercially safe to use for your ad.
So let's get into that and explain that for people. So for example, there's lots of other competitors right now for this text, prompt to text AI generation.
Yep.
You can use, Meta has a version.
Midjourney.
Midjourney. Yep. But they are getting the data or the info from maybe YouTube, maybe from Meta's Reels or Instagram, maybe from TikTok, maybe from the internet. But if you can't use them in a commercial or a website because they may violate copyright law. Whereas if the only viable option as a company, if Baskin Wealth were to use AI, the only one we could trust was Adobe. Like, if not, you're going to get sued. Someone's going to scrub and find this stuff and send you a cease and desist order or send you a bill because you're using copyright footage in your ad. Big risk.
And I think this is a big, important factor for driving Adobe's business going forward, is because Adobe's customer base primarily is commercial enterprises who are using Adobe tools to make ads or content. And it's for these companies, it's essential that they're not going to get sued over something that they create.
Yeah.
And so it plays really nicely into Adobe's strategy for implementing AI in these markets going forward.
And how is Adobe going to, the most important for us is, how's Adobe going to make money off this for shareholders?
Yeah, so Adobe has different models for monetizing their AI products. They have what they call generative packs, AI packs, where if you're a user, it entitles you to, let's say, like, I think it's like 20 generations a month or something like that, right? And you can pay more to generate more features.
Yeah.
For other things such as Acrobat, it's simply an add-on, right? Like the ability for you to search through a PDF and ask for summaries. So that's another thing that they're doing. And then there's also standalone products that they're making, such as Adobe Express, which are totally new products that are built with AI from the ground up, right? So those are the kind of things that Adobe is making. And I think the second thing that Adobe is trying to argue is that they're the ones who have the tools for you to be able to edit the things that you're creating from AI. Because the term that they used was, like, if you create like a cool image on Midjourney, it's just basically a party trick. It's just something for you to show off to your friends, right? But then ultimately, your ability to be able to turn that into an ad or a banner or anything, it's the workflows like the Photoshops, the Frame.io, these products that Adobe provides that is going to end up enabling you to use that image. And Adobe thinks that, like, don't ask a barber for a haircut, but Adobe thinks that it's very well positioned to serve that.
I think, your brain can go in a lot of different places here, but I think this generative AI is going to unlock so many use cases for Adobe. We're not there yet, but specified targeted ads featuring your favorite I don't know, movie star or musician or wrestler can really unlock, so many social media ads targeted directly to you and your favorites on Meta, or on Google or what have you. So I'm surprised the day that the announcement came out, Adobe stock jumped but gave it back because market is still unsure whether Adobe is going to be an AI winner or an AI loser. But in our opinion, this really pushes Adobe to the forefront of a winner in the new AI world. So.
And they gave the CEO, Shantanu Narayan, he gave a good stat for people who are worried that AI is going to kill all creative jobs going forward.
Yeah.
He said that in their surveys, it shows that 9 out of 10 creative teams say that they're hiring people because AI is enabling them to do so much more.
Fascinating stuff.
So in contrast to what you would expect, not only is Adobe not losing users, they're actually gaining users. And, time will tell.
Time will tell.
When that translates to improved revenue growth. But I think the story's there.
Adobe fits the type of company that we like to own for clients. Great services. And as it unleashes more products and services, can continue to grow its pie, take market share, and sell additional services to users and at higher prices. And terrific capital allocation, strong balance sheet. Valuation, obviously, the stock has fallen recently, so probably a lot more reasonable than it was at the start of the year. Anything else to add there?
Well, while we're on the topic of AI, I think it'd be interesting to report on my own experiments with AI in research.
Please, this is fascinating. So you've been using AI a little bit to do investment research?
Yeah, I think anytime there's an opportunity to do things better or learn things a little bit faster, you want to experiment with them. And I've been doing that. I've tried some of the search tools that exist, like ChatGPT, Perplexity, like Google Gemini, to find data to varying degrees of success, I would say. And I've tried, I think the one tool that I've found really impressive was Google Notebook LM. So it's basically a product it's free for anybody to sign up. It's a notebook that you can upload any document into it and ask it summaries from the AI.
Okay.
I think the most impressive part is that you can actually ask the AI to generate a podcast of that document.
Yeah.
So if I'm uploading Coca-Cola annual report into Notebook LM, I can say, create a podcast for this. And it creates this super convincing podcast that's 30 minutes long.
Yeah.
And will explain everything you need to know about Coca-Cola's business model, their economics, their financial capital allocation track record, and all those things.
And all for free.
All for free.
Yeah. I have a lawyer friend who I was talking with on the weekend, Ernest. He said he had to read a 25,000 page document, 25,000 pages. And I said, how did you do that? Well, he said, it was a team of us and I had to read it over a multiple week period. And this is not just reading, and falling asleep after 5 minutes. This is active reading.
Yes.
So I can imagine how life-changing that this could be if he could upload that 25,000 page document and at least create a good summary to get the knowledge immediately of what he's reading and how it all works, right? We've been using AI for Zoom here for meetings that we have with clients or internal meetings. It does a great job of immediately summarizing the notes, full transcription, as well as action items that happen right after the meeting. And this is just, we're not even in the first inning of AI. We're not even thinking about the baseball game yet. It's so early. And so you can imagine all the tools and productivity that are going to improve everybody's business and personal lives. Hopefully, you talk about the demos, of course. Elon Musk had the demo of the humanoid robot that apparently is going to, take care of our kids and take my father to the eye doctor appointment. Unfortunately, the demo was kind of BS right now, right?
Yeah, not only was it remote controlled in the back, but for the record, I'm actually out on humanoid robots.
Yeah,
I just don't think they're going to be a thing. That's neither here nor there. But
yeah, have you seen that show Battlestar Galactica with the Cylons?
No.
All right, yeah. Maybe you'll catch it one day. It's we don't want them replacing us.
No, my mental model for humanoid robots is C-3PO.
Yeah.
It basically just stands there and provides translations for you.
Yeah.
And doesn't do anything else.
Comic relief, actually, C-3PO. Yeah.
So back to Notebook LM.
Yeah.
I find that for my own research purposes, it's really useful for getting up to speed on topics that you don't know. Yeah. So, for example, if a newspaper reporter calls and says, "What's your opinion on this topic?"
Yeah.
Right? Then you can get an answer in like 2 minutes versus having to read all of the things about a topic that you barely know about.
Which begs the question: why is a newspaper reporter looking for a quote from you? But anyways,
yes,
yeah.
But I find that the downside of using these tools is that it still hallucinates. It makes up connections that are not there, right? And oftentimes, like the reason that I read transcripts of conference calls and those kinds of things is because there's a lot of nuance to the conversations that the management is saying in response to analyst questions. And that nuance is lost when you're using AI, which is why it hasn't even like replaced a material portion of what I'm doing on a day-to-day basis. So, like we'll see what happens. I always want to do things more efficiently, but I'm excited to see how it goes from here.
All right. So good to know. And for clients, good to know that we won't be replacing Ernest yet with AI. Not yet. So we had more updates on the Alimentation Couche-Tard takeover potential takeover offer of 7-Eleven. First of all, the name of the company in Japan is 7 & I. They propose to actually change the name of their company to 7-Eleven. So we'll now just call the takeover target 7-Eleven instead of 7 & I.
Yes.
Okay. So the recent news is Couche-Tard raised its offer by 22% to about $45 billion. $47 billion US or Canadian? US. Which is pretty much near the market cap of Couche-Tard stock today. So essentially, it's not quite the minnow swallowing the fish, so to speak, but it's a pretty big bet that Couche-Tard is hoping to make on 7-Eleven.
Fish eating a fish.
Fish eating a fish, yeah. So that sounds kind of gross. So Ernest, you know more of the details, so why don't you hit the highlights on the latest increased target by Couche-Tard on 7-Eleven.
So the timeline is that Couche-Tard first submitted its offer in August, which was promptly rejected by 7-Eleven. Saying that the offer was A, inadequate, and B, didn't meet the criteria for, like regulatory issues and those kinds of things. Couche-Tard then hired advisors. They hired investment banks to help them, try to come up with ways to meet these issues. And they submitted a revised offer on September 19th. So about a month later, which we didn't know about.
Yes.
Until October, I think October 9th.
Yeah, pretty much a week or 10 days ago. Yeah. And it came out in the newspaper.
Yeah, it came out in the newspaper, and 7-Eleven, didn't say anything about this offer. So we don't know what happened with it.
Did they even acknowledge the offer on their conference call that 7-Eleven when they reported earnings?
They did. Yeah. They acknowledged that they received an offer, but no other details. It's been like 3 weeks.
This is the strangest thing. Yeah.
But between that period, 7-Eleven first got the core national security designation from the Japanese government that it wanted. But the Japanese government then said, okay, you got the designation, but you still have to take this offer seriously.
The designation means that 7-Eleven is seen as a protected business, right?
And a core business.
A core business to Japan because its stores are essentially open 24/7. And as a result of the pandemic, it was, as you mentioned on one of the previous podcasts, it was the only place you could go to get your food, your drinks, important stuff. And so as a result, it's convenience stores who would have thought, are core to the importance of the country's health and security. Yeah.
So they got that. And then in early October, remember, this is after they received Couche-Tard's updated bid.
Yeah.
7-Eleven then tried to sell 7-Bank and Ito Yokado, which is a department store, and some of its like supermarkets and other assets.
So non-core assets, non-convenience store assets.
So there was reporting that they tried to sell this stuff. I guess it probably didn't go too well because no one wanted these things. And then they bundled together all of their non-core assets, which is everything that's not convenience store, and includes 7-Bank. It includes like Denny's restaurants in Japan. It includes like Tower Records. Like it's a whole mishmash of stuff. They bundled these things into a company called York Holdings. And they said, we're going to separate this from 7-Eleven and rebrand the whole business to 7-Eleven.
Okay.
And that was kind of viewed as a move to appease the investors who wanted 7-Eleven to take Couche-Tard's bid seriously because it's a big premium to where the stock was.
Huge premium.
Like, we don't know exactly what's going to happen still. Like, again, they haven't responded to Couche-Tard's offer. But there are rumblings, both in Japan and from its shareholders around the world, that they should take a serious look at this because it's quite a big premium to what the stock price was trading at. And, we'll see what happens.
Yeah. In the meantime, Couche-Tard has not commented to the media about the takeover offer or how it values 7-Eleven or what type of financing it already has lined up. There's been posts in the newspapers saying that Couche-Tard does have financing by a number of the Quebec-based pensions, as well as institutional investors. And essentially, they're saying it won't be a problem for them to raise funds. In the meantime, Ernest, 7-Eleven stock is at a high price, so it's trading at a premium to where it was pre-bid. And Couche-Tard stock is down about 10 to 15% since it made the bid. What is surprising to us is, and I made a tweet about it, Couche-Tard's in the acquisition business. This is what it does for a living. Convenience store is not a fast-growing business. This is not a business that grows 5 to 8% a year. Hopefully, you want same-store sales growth that is positive over the long term. But it's in the business of making acquisitions, making big acquisitions, integrating those acquisitions and wringing out those synergies and doing it again over and over again. We own lots of companies in our portfolio that are in the business of making acquisitions, like a Constellation Software. So we're shocked how poorly Couche-Tard's stock price is done. Maybe it's just arbitragers. Maybe it's those that are betting that there's going to be if it goes through, Couche-Tard will have to issue a lot of stock. And as a result, that could put pressure on the stock price. Hard to know. Does any of this matter in the short term? Yes, but does it matter in the long term? If Couche-Tard is successful and given their track record of acquisitions and the synergies that it may be able to wring out, the stock price should go much, much higher.
So, I think to your point, a lot of investors have been questioning whether Couche-Tard is biting more than it can chew.
Yeah.
Or is that the right term?
Yeah, that's a fair term. Yeah.
Biting off more than it can chew with this deal.
Gorging at the buffet. Yeah.
And whether, Alain Bouchard, the chairman, is simply trying to just grow the business for the sake of growing it.
Yeah, or maybe given his, he's not a young guy. Maybe this is the last hurrah. Get it done. Yeah. This is my legacy. I wanted to buy 7-Eleven. I think they wanted to buy 7-Eleven since 2004, 2005, like a very long time, and get it done. Others are questioning, of course, this shows that Couche-Tard is desperate and his business is in the toilet and they need to do something splashy and they're overpaying. I mean, it's all rumors, speculation. Nobody knows.
Well, I think for those who have followed Alain Bouchard throughout his career, you shouldn't be surprised at all that this is what he's doing.
Yeah.
He has a history of making extremely bold bets for large acquisitions at the time when he feels is opportunistic.
Yeah.
He did that when he first went into the US. He did that when he first went into Europe. So like I think, and he's tried to acquire many large companies in the past.
Yeah.
So I think there's no surprise at all that he's going to try and acquire 7-Eleven.
So yeah,
And,
go ahead. Sorry.
And I think as for those I think the deal rationale is actually like quite simple if you boil it down, right?
And you tweeted about this. Yep.
It's basically that the price that the new price that they're proposing, $47 billion, it's about under 7 times analyst expectations for 7-Eleven's EBITDA.
Although 7-Eleven did not report good results in its most recent quarter. So maybe maybe a little higher now, but anyways.
Yeah. But basically they're paying under 7 times EBITDA.
Okay.
Couche-Tard stock is trading at about 11 times EBITDA. So about 4 turns higher.
Yeah.
And in essence, what Couche-Tard is doing is they're selling stock, or they are going to be issuing stock at 11 times to buy 7-Eleven, which is the leader in the world, at 7 times. And to me, that just seems like a no-brainer.
It does. It seems like you're picking up free money.
Yep.
Are there risks? Sure. When you issue stock, you cause dilution. There could be issues with, things can happen. The economy can turn. There may be troubles. The Japanese may not want to go to 7-Eleven anymore because they now they have a Canadian owner. Who knows what's going to happen? But the bottom line is, if you boil it down to simple math, it looks very, very attractive, the deal.
And even more interestingly is that to the extent that they succeed, 7-Eleven bought a gas station chain called Marathon in 2020, which Couche-Tard was bidding for as well, but ended up losing to 7-Eleven.
Yeah.
They paid 13 times EBITDA for Marathon. So you could argue that Couche-Tard is offering 7 times for a portion of the business that 7-Eleven paid 13 times for.
Yeah.
And if you put it in that perspective, then it looks even more attractive.
Yeah.
So no, we don't know what will happen. We don't know if Couche-Tard will end up being able to buy 7-Eleven.
Yeah.
But I think I'm very supportive. I hope they are able to do it.
Yeah, the bottom line is right now we're kind of in the dark. There's been no discussion between, the two companies, so hard to know what's going to happen. What I would say, Ernest, is Couche-Tard does have a history of making a number of bids when it really wants something. So this may not be the final bid that it offers. And what I do know is if this deal doesn't go through, expect Couche-Tard to just be making other acquisitions going forward. So it won't stop.
And I guess one last thing I would say is that Couche-Tard isn't going to pay any price for 7-Eleven. They have a track record of knowing when they shouldn't, when it's time to stop.
Yeah.
In 2010, they tried to acquire a company called Casey's, which is a large convenience store in the US. And it got to a point where Casey just wanted too high of a price. And they said, no, we're out.
Yeah.
And again, like that happened with Marathon when Couche-Tard just let 7-Eleven buy it.
Yeah.
So at a certain point, I think you have to understand that Couche-Tard is going to be prudent with their money. Like they know what they want to pay.
With your money.
Yes.
Yeah. And Alain Bouchard's money. Yeah.
They know what they want to pay. And if it gets too pricey, they're going to walk away.
Yeah. And we'll be watching that very carefully. The final company we want to talk about that reported earnings was Domino's Pizza.
Yep.
And on the day it reported earnings, the stock price fell, which was it's always surprising. You never know what the market's thinking, what's priced in. I think the headline numbers were good, but the guidance was maybe a little bit less than expected. But then, of course, the market had a sober second thought the next day. And what we saw from Domino's earnings is, even though there has been admittedly a slowdown for quick service restaurants, whether because of inflation, the tightening of consumers, maybe they're eating more at home now, whatever it is, there was something under the hood that was really spectacular about Domino's, even though the guidance wasn't that great. And you'll tell everybody why.
I always feel like people fall asleep when we talk about Domino's. I don't know if it's because people don't like their pizza, or
no, they hate the pizza. That is a guarantee,
or whether they just don't find the business model that interesting. But
everybody will tell me, I think they're embarrassed. Like I talk to people, they say, oh yeah, I ordered Domino's pizza, but it's really cheap. So like there's always a qualifier there. You're allowed to also enjoy the pizza if you like it. It's fine, but definitely the convenience and the price makes a lot of sense for those ordering.
No, I think a lot of it is that, investors like big stories.
Yeah.
They like Tesla is going to, turn all of the parking lots into parks in the world because of autonomous vehicles.
Yeah.
They want these kind of stories, whereas Domino's releasing a quirky twist on buy one get one free marketing.
Yeah.
Like, that's kind of boring, and it's just not, there's no sexy narrative to that.
Or it announcing that it's going to have buffalo chicken mac and cheese.
Sounds good.
It sounds good, but that's not going to unleash a total addressable market of $10 trillion.
Right.
Yeah.
But I think what you often see is that it's these little things, right? Like being smart on your products, like being smart on how you are marketing to consumers. These are the things that end up driving a large portion of the value of the company, because that's how you win people ordering from Domino's versus Pizza Hut versus Papa John's versus Pizza on a daily basis. And Domino's, their execution has been terrific. Like first of all, when the whole industry was raising prices in 2023, they decided not to raise prices. So we've talked about this in the
past. There was one price raise. I think they raised the price.
In 22.
Yeah. Yep. They raised the price from $5.99 to $6.99.
Yeah, for the national offer.
Yeah.
And then they held prices while everyone else was raising prices. So in the mind of the consumer, they've already established that, we want to be the attractive option for affordable pizza.
Yeah, of all the crappy pizzas out there, we got the lowest price of the crappy pizzas.
And Domino's can do that because they have the best franchisee profitability at the stores, because they have the most volumes. So that's the first step. And then they followed up on that with outstanding marketing execution. So they had a promotion called what they called emergency pizza, which is essentially like a buy one, get one free.
Yeah.
Like you buy a pepperoni pizza, you get one for free. But
only during a limited time window, right? Yeah. For a week or 2 weeks or what have you. Yeah.
But the way that it was framed is like, oh, we're giving you a free pizza for whenever you need it.
Yeah.
And it actually really resonated with consumers. People actually really liked it.
Yeah.
And then they had another marketing campaign where they put a twist to shrinkflation, right? Where, I think a lot of people are understandably upset that before you used to get 8 nuggets and now you're getting 6 for the same price, right? Whereas Domino's came up with a promotion saying, oh, now to counter that, when you're buying a medium pepperoni pizza, you get a large. You get to upgrade for free.
Yeah.
And like these are the
medium pizzas are smaller these days. That's a guarantee. Yeah.
But they are doing all of these little things that I think people really value, especially in a time when the lower income consumer is struggling.
I like the one where they had, if you come and pick up your pizza, we'll give you the tip.
Yep.
Right? So we'll give you $2 or $3 off your pizza if you carry it out, which I think did a lot of good business for it.
Yep. And so Domino's is in as good of a place as they've ever been. There was a little bit of like commentary that competitors were trying to copy their promotions, but like I think there was a quip by the CEO that it's hard for their competitors to do it because they're making less money. So any promotion that their competitors are doing are just sacrificing margin and something that is going to be detrimental to their long-term store opening opportunity.
Makes sense to me.
So I think Domino's is really well positioned. It's a very well-run business, and I'm glad we own it.
Yeah, so even in a tough market, Domino's is able to take market share, which is, once you grab that market share, it's hard to give it back. And by keeping the prices low, as you mentioned, by offering these great deals, by having the best loyalty program, by having the quickest delivery, Domino's has been able to grow the pizza pie in a time when things are really, really tough. And Ernest, is there any sense that we're in a cyclical time period and things for the low income consumer or these types of fast food restaurants will normalize again? What did Domino's management have to say about that?
Well, I think these things are generally pretty hard to predict.
Yeah.
I think Domino's, analysts asked this question to the CEO and he said, the economy is going to be what it is.
Yeah.
Right. But as long as we focus on providing good value, then the results are going to speak for themselves.
And what's very exciting for us as investors is the free cash flow that Domino's generates is incredible. And it looked like it ramped up the share buybacks during the quarter as well.
Yes.
Yeah. So it's telling you that it feels the stock is undervalued. And we're hopeful that the next few years will be very strong for the pizza business. Anything else you want to add on Domino's?
No, maybe I'll order some tonight.
I'm getting hungry now. I hope you're getting hungry too. And don't forget to sign up for our webinar. The link will be in our show notes. The link is also on our website at baskinwealth.com. Once again, it's free. It will be live at 7 p.m. on October 29th. If you can't join us, don't worry. We'll record it and we'll put it on YouTube. We'll link it to our website. We'll link it to our next podcast so you can check it out. And we appreciate all your support, and we'll see you back here real soon.